Is infinite banking a good strategy for retirement planning? We're going to dive into that today, but first make sure to hit that subscribe button so you don't miss another video. Today we're talking about infinite banking and how it can fit inside of a retirement plan and if it's even a good idea for your retirement plan. First, let's talk a little bit about infinite banking and what this is. Most of our clients are utilizing infinite banking to create wealth. The way that this works is they will use a max overfunded dividend paying whole life insurance policy, or in short, an infinite banking policy, and they're going to capitalize that or put premium into the policy, build up cash value, and then they'll take a loan from the cash value and use that loan to go out and create wealth in single family real estate, syndications, self-storage, any sort of alternative asset that's going to produce a cash flow. As that cash flow comes back in, they're going to take it and put it back into the policy and repay that loan. This isn't because they have to do this, but strategically they want to do this so that they can replenish the account so that they're ready to take another loan and create another investment. This is a very brief way of understanding what infinite banking is. But what a lot of people don't realize is what happens after you're done utilizing the policy for infinite banking. This is where it can come in handy in retirement planning. Here's how this is done. The first way you use infinite banking is in the traditional sense, where you're taking loans from the policy, you're using those loans to go out and invest and create wealth, and then you're funneling those loans back into the policy to replenish the fund, to repeat that process and do it again. The second phase of infinite banking is what I like to call the tax-free income phase. And this is an optional phase. What a lot of people will say is, Brennan, I've got $2 million sitting in my cash value at this point. I've utilized it to create wealth. I've done the infinite banking strategy. I love it, but I'm slowing down a little bit on my investments. I'm not utilizing the cash value in my account so much for investing, and maybe they just want to get into a little bit more of a traditional retirement phase of life. Here's how this works inside of the infinite banking policy. You can actually utilize your policy now to create an additional stream of tax-free income. The way that this works is, let's say you have $2 million sitting in your cash value. This is going to be producing roughly 5% inside of the policy itself. So your $2 million is going to be producing $100,000 of growth every single year. Well, if you wanted to keep the death benefit higher for your beneficiaries or for your estate, you can easily just take the $100,000 a year that it's growing by every single year as tax-free income. By doing this, you preserve the death benefit for your beneficiaries, but you also are able to utilize the policy as an additional stream of income, and it being tax-free will mean much more in your portfolio than even your market-based accounts that are going to be sometimes fully taxable and other times capital gains tax. Let's talk a little bit about how you're going to access these funds, how these withdrawals are coming out, because that's important to understand as you're pulling these things out for tax-free income. The first portion of income that you're going to be taking is actually the basis that you put into the policy. Let me be clear. Let's say that over the course of the last 20, 25 years, you put in $700,000 of principal or $700,000 of premium into the policy. This policy has grown up to $2 million, so you've got an extra $1.3 million of growth. The first $700,000 that comes out is going to come out as a withdrawal because we're just accessing our basis. Life insurance is unique in that it's first in, first out accounting. You can take out your basis without touching any of the growth of the policy. So the first $700,000 of income is going to come as a withdrawal. That's going to be tax-free. We're not hitting the growth in that. Once we get to the $1.3 million of growth inside the policy, we're then going to strategically switch over to taking a loan on the policy. We're doing this because we want to keep this income coming to us tax-free. Now, we're not going to be paying interest on these loans. We're not going to worry about paying back the loans because the death benefit is actually going to pay off those loans once we pass. So we take tax-free loans for the next 15, 20 years, however long we're taking that income. And then as we die, that death benefit is first going to pay off any outstanding loans on the policy. And then the remainder of the death benefit is going to go directly to the trust or beneficiaries, whoever you've designated to handle that. So as far as infinite banking being a good strategy for retirement planning, I think so far it's proving its case fairly well. And I'm not done. Another way you can utilize infinite banking in retirement planning, and this really goes for any cash value life insurance policy that's out there, is you can utilize this as a volatility buffer. A volatility buffer is going to extend the life of your market-based assets. Let me give you an example. Let's say there's a significant drop in the market 5 years into you taking income out of your retirement accounts. So your account drops by 25%. What a cash value life insurance policy or an infinite banking policy can do is actually allow you to let those accounts recover. Or in other words, you're not going to pull any income that next year from your market-based assets because you want those to recover before selling off any more assets from those accounts. You can only do this if you have a different asset sitting in an account that is not correlated or not affected by the returns of the stock market. Enter in an infinite banking policy. An infinite banking policy is guaranteed. It's going to grow consistently at 5%. It's been doing that for the last 150 years with most of these insurance companies. So you can count on that happening every single year. Well, when there's a downturn in the market, the next year, you're only going to pull income from your non-correlated asset or your infinite banking policy. This will allow your market-based assets to recover so that when the next year rolls around, assuming they've recovered, you're going to pull income out of your market-based assets again. If there's another down year, 2 down years in a row, you're going to pull income purely from your infinite banking policy again until those accounts recover. By doing this, you don't have to sell any assets at a loss ever. You can only sell assets as they're growing every single year. You can imagine that this extends the life of your retirement planning in a big way. And finally, let me talk to you about the third benefit to infinite banking in retirement planning, and that is the long-term care riders that are on these policies. Now, let me be clear. The infinite banking policy isn't a long-term care policy in itself. It has a rider or an additional benefit that is written into the contract that would allow you to access the death benefit of the policy early if you qualify for long-term care. And the way that you would qualify for long-term care is if you can't perform 2 of the 6 daily activities of living, or if there's a cognitive impairment, you have the ability to access the death benefit early to pay for any sort of long-term care. It could be in home, it could be in a facility, any kind of long-term care that you need, you have the ability to access right from the death benefit of your infinite banking policy. So let me recap. There's 3 huge benefits to having an infinite banking policy as part of your retirement plan. The first is tax-free income from the policy. The second is a volatility buffer and a non-correlated asset. And then the third is a long-term care rider that would allow you to access the death benefit early should you need any sort of long-term care. I hope you found this video helpful. Make sure you drop any comments or questions in the comment section below and I'll respond as quickly as I can. Make sure to hit that subscribe button so you don't miss any other videos that I'm posting out there. And make sure to give it a thumbs up if you like the video, and we'll look forward to seeing you on the next video.